Hey everyone, welcome back to Corporate Decoder, the place where we break down these thick financial reports so you don't have to. And today we're diving into the Federated Hermes Intermediate Municipal Trust's latest filing. Something tells me this one might be a bit of a snooze fest, but hey, that's what we're here for, to find the hidden gems or confirm our suspicions and maybe learn a little about municipal bonds along the way before we jump into the deep end of this report. If you appreciate getting straight insights from these filings and want to stay ahead of the curve, make sure you hit that subscribe button and join our growing community on Discord, also linked in the description below. Now let's see what our friends at Federated Hermes have been up to. This report is all about the Federated Hermes Intermediate Municipal Fund, a part of the Federated Hermes Intermediate Municipal Trust. And it covers their performance and financial health up to May 31st, 2025. Essentially, it's a look back at how the fund has been doing, how much it costs to invest in it, and what's in its portfolio. They want to give shareholders all the juicy details about fund performance management and even some of the nitty-gritty financials. Let's talk about cost first, because nobody likes unexpected expenses. For a $10,000 investment class A, shares came with a cost of $71, which is zero, covers the management and operational costs of running the fund. Pretty standard stuff in the investment world. Now, for the part that really matters, performance, they compare themselves to the S&P Municipal Bond Intermediate Index and even the broader S&P Municipal Bond Index. Think of these indexes as a benchmark, a way to see if the fund is doing better or worse than the overall market. So how did they do? Well, credit allocation was a big plus. They took on more risk by investing in BBB rated and below investment grade securities, which ended up outperforming the index. This also meant they had less exposure to AAA and AA rated securities, which actually underperformed, so their little gamble paid off here. Sector allocation also gave them a small boost, with some of their bets on advanced refunded airport and senior care sectors doing better than expected. Meanwhile, their underweights in general obligations, housing, public power and water sewer sectors hurt them a bit, but not enough to cancel out the gains. Duration management, which is basically managing how sensitive the fund is to interest rate, and senior care sectors doing better than expected. Meanwhile, their underweights in general obligations, housing, public power and water sewer sectors hurt them a bit, but not enough to cancel out the gains. Duration management, which is basically managing how sensitive the fund is to interest rate changes, also contributed a small positive amount. But it wasn't all smooth sailing. Yield curve positioning actually hurt them. They held more long-term bonds where interest rates went up and less in the middle range where rates stayed steady or even dropped. Security selection was another blow. Even after accounting for all their strategic moves, they still underperformed the index, partly because bonds with maturities longer than 15 years saw their yields jump quite a bit, over 40 basis points. That's a pretty significant move against them. Let's look at some numbers here for context. The Class A shares without sales load actually returned 213% in 1 year and 1.95% over 5 years. Now compare that to the S&P Municipal Bond Intermediate Index, which returned 3.48% over 5 years. So while the fund had some good calls, the index generally did better. Not a huge gap, but noticeable. And remember, these numbers don't include taxes you might pay on those gains. A couple of quick stats for you. The fund has 174,983,068 in net assets, meaning that's the total value of everything in the fund they've invested in 18.7 different securities, and their portfolio turnover rate, which is how often they buy and sell assets, is at 29%. This means they're moderately active in managing their holdings. Something interesting happening on the management front. Derek Plasky is joining the portfolio management team effective July 29th, 2025. So in addition to the team that might bring some fresh perspectives or strategies, when it comes to ethics, the company states they have a code of ethics that applies to their top executives, including the principal executive and financial officers. No changes or waivers were made to this code during the reporting period, which is usually a good sign when it comes to compliance. Here's a look at what they paid their auditors. For the year ending May 2025, they paid $35,989 in audit fees and $0 for audit-related tax or other services. This suggests a pretty straightforward relationship with their auditor and no major consulting work being done by them. All right, now we get to the heart of the matter, the detailed financial statements of Federated Hermes Intermediate Municipal Fund. This section gives us the nitty-gritty on where all that money is invested. As of May 31, 2025, the fund held a substantial amount in municipal bonds, making up 96.9% of their portfolio. This is their core business. You can see they invest across many states with significant allocations to Texas at 10.0% and New York at 9.5%. For example, they have a $10 million investment in Texas state UT-GO bonds maturing in 2041 and a $16.6 million states like Florida, California, and Illinois in an investment in Texas state UT-GO bonds maturing in 2041 and a $16.6 million states like Florida, California, and Illinois. Beyond the long-term municipal bonds, they also hold 2.0% in short-term municipals, totaling $3 million. These are typically more liquid and less sensitive to interest rate changes. For instance, they have $1.7 million in Ohio State Higher Educational Facility Commission bonds that are variable rate demand notes due June 2nd, 2025. Adding it all up, their total investments in securities come in at $173,800. This represents a massive 98.9% of the fund's net assets, clearly showing their commitment to these types of investments. The identified cost for these investments was $172,000 on $45,729 Hert. When valuing their assets, they primarily use level 2 inputs, which are observable inputs like interest rates and credit risk. This means they rely on market data rather than making their own subjective assessments for the vast majority of their holdings, specifically their municipal bonds and short-term municipals, are valued using these observable inputs. This is generally a good sign for transparency and reliability in their valuations. Looking at the financial highlights for Class A shares, we see that for the year ended May 31st, 2025, the net asset value per share started at 9.59 and ended at 9.51 after accounting for income and distributions. The total return for this class was 2.3%, which is that modest gain we talked about earlier. The net expense ratio for Class A shares is 8.70%, which is actually after some expense waivers and reimbursements, meaning the actual cost could have been higher without that help. For the institutional shares, the story is quite similar. The net asset value started at $9.20.99 and ended at $9.20.51, slightly better total return of 2.35%. This isn't surprising, as institutional shares typically have lower expense ratios, and indeed theirs is 0.45%, which is significantly lower than Class A sharing in the same expense waivers and reimbursements, and $45.10, which is significantly lower than Class A sharing in the same expense waivers and reimbursements. Diving deeper into the statement of assets and liabilities as of May 31st, 2025. The fund's total assets stand at over $177.5 million, with investments being the largest chunk. Liabilities are quite small, at around $486,000, resulting in net assets of $174,983,608. This shows a very healthy balance sheet, with liabilities being a tiny fraction of assets. The statement of operations shows that the fund had investment income of over $6 up to over $1.4 million, primarily from interest, but expenses tallied up to over $1.4 million, including advisory fees, fees and audit fees. However, they did benefit from a waiver of investment advisor fees of about $2,800, which helped bring down their net expenses considerably, leading to a net investment income of nearly $5.9 million, which helped bring down their net expenses considerably, leading to a net investment income of nearly $5.9 million, which helped bring down their net expenses considerably, leading to a net investment income of nearly $5.9 million, and $9 million, bring $9 million expenses considerably, leading to a net investment income of nearly $5.9 million, of reduction in custodian fees of about $2,008 and a reduction in custodian fees of about $2.21 per $100, which helped bring down their net expenses considerably, leading to. Looking at the statement of changes in net assets for the year ending May 2025, the fund saw a decrease in net assets of about $11.25 million. This was primarily due to distributions to shareholders totaling nearly $5.9 million, in a significant outflow from share transactions where shares redeemed outpaced shares sold by about $10 million. This indicates that more investors pulled money out of the fund than invested new money during this period, the opposite of what happened the previous year when they saw a significant increase in their assets of about The notes to the financial statements clarify a few key things. First, the fund invests heavily in municipal bonds, which can sometimes be subject to federal AMT for individuals and state and local taxes. Also, they hold restricted securities, meaning some investments can't be easily sold on the open market. These restricted securities total over $4.1 million or 2.4% of net assets. They also use futures contracts for risk management and their financial activities. Adhere to strict accounting policies. The independent auditors have given a clean bill of health here. They confirm that the financial statements present fairly the fund's financial position aberrations in accordance with US generally accepted accounting principles. Their audit was conducted following PCAOB standards, ensuring a thorough examination of the fund's financials. This section is quite extensive. It details how the Board of Trustees reviewed and approved the investment advisory contract with Federated Investment Management Company. They considered performance fees, ethics, and the overall quality of services provided. They noted that the fund's performance was below the peer median for 1 year, but above for 3 and 5 year periods. Importantly, they found the fees and expenses to be reasonable considering all the factors and the advisory team's capabilities. They also discussed economies of scale for the fund and how those benefits might be shared. They also approved the contract as part of a broader review of the Federated Hermes funds family, but on a fund-by-fund basis and considers to be reasonable, considering all the factors and the advisory team's capabilities. They also discussed economies of scale for the fund and how those benefits might be shared. They also approved the contract as part of a broader review of the Federated Hermes funds family, but on a fund-by-fund basis. The company affirms that their disclosure controls and procedures are effective and that there have been no changes to their internal control over financial reporting that would materially affect them. This is a standard report on their internal checks and balances and compliance. Finally, in the exhibits, they've included certifications from their principal executive and financial officers confirming the accuracy of the report. And yes, there are those crucial certifications required by securities laws stating management has reviewed and approved the filing. So wrapping up, this filing for Federated Hermes Intermediate Municipal Trust paints a picture of a fund focused on municipal bonds navigating market fluctuations with a mix of success and some challenges. Their performance was a bit of a mixed bag compared to the market indexes, with some strategic bets paying off and others not so much. The costs are in line with industry standards and their financial health looks solid with a clean audit report and strong internal controls. What really stands out is the slight outflow of assets as more investors redeemed their shares than invested new money during this period, which is something to keep an eye on for future quarters. The management team seems solid and the board's approval of the advisory contract suggests confidence in their strategy. Overall, the Federated Hermes Intermediate Municipal Fund appears to be a stable, if not spectacular, performer in the municipal bond space. The use of observable inputs for valuation is a positive sign, and any potential impact from interest rate changes and credit quality is inherent to this type of investment. The slight net asset outflow is a potential concern, but without more context regarding broader market trends, it's hard to say if this is a fund-specific issue or a general market movement. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.